Good day, everybody. Brian here from quantlabsnet.com. This demo I'm about to show you is created by AI once again. And basically, I generated a set of reports on my futures and options yesterday with institutional level type of suggestions for trading with arbitrage, hedging, and the like. So I fed in to allocate a now again, this is for demonstration purposes only. But again, if we were to mock a $50,000 portfolio using medium frequency, now this is in Python, and we're using medium frequency, so there's no high frequency here. And the other thing I put in was just for demonstration purposes on the coding front was the fixed protocol integration. So that kind of complicated the code generation. Anyways, the important thing here is we can do a 30-day simulation. I'm going to show you 30-day, 100 points per day. And right now, this is the current setup for the simulation. Here we have our initial capital, current value, and we'll do a total P&L, and then we'll do a P&L percentage as well. So this is probably what you're seeing in your typical trading portfolio lately since the beginning of April. I do believe today is May 7th or 8th. And in here, you'll find that we've got different types of instruments that we're purchasing for futures and options. We've got agriculture, we've got cash reserve, we've got uh, what they call, I guess, core device diversifiers, growth, and global exposure. But this is the cool part. So this is our 30-day analysis. One thing you want to really watch for is to only focus within this proposed portfolio, only the ones that are in green. I say that based upon my own experience. If you want to maximize your profit potential, you only want to, as I said, only have the green in your portfolio. Now, in each one, you'll get the initial capital allocation suggested, the current, the P&L projected. So this would be for the euro, using some form of mean reversion, using euro again for mean reversion. Again, these are future contracts, currencies. These are not retail forex as well. And again, this is only for demonstration purposes. So in here we have euro, British pound, Japanese yen, and the ZB as well, and another one ZR. So in here, again, these are proposed allocations. I have to reallocate them or recalibrate them if I'm taking out the rest, and maybe rerun this code. The code contains um, all of these assets as what I showed you in that report, but that's not very good. Okay, but again, if you want to only have profitable, again, focus only on the green. So in here, if I was to uh, recalibrate, but this is as is, which means we'd get a 10% loss. But the idea here is it shows you on what to take out to maximize your profit potential. So obviously you don't want to have any of these red with the volatility because it's too high. I mentioned that before in a past video. You just don't want high volatility, highly volatile, um, highly volatile assets in your portfolio if you're going to put this on for 30 days. Okay, so in here, as I've mentioned, I've included everything, all currencies, crypto, and whatnot. So in here, we have Ethereum, which you take out, cotton, orange juice, and again, the only ones that are making a little bit of money are the currencies. Canadian, here's your your strategy type that you would want to apply. Your mean reversion along here. Again, for your ZB, now you're going to do trend following, ZN, trend following, everything else you take out. And then you can probably rerun it if you got the code, right? So again, that's the mix, and this would be your allocation as well. And then here would be your, actually, there is, yep, there you go. There's the typical hypothetical that you probably see on trading platforms, proposed trading positions on the buy and sell of each. All right, so that's the cool part. So I could do a 7-day as well, or let me do a 5-day. So 5 simulating days, and it should rerun and refresh everything. So there you go. So again, you can see where you can rebalance everything. So here, let's see how our read is. So we have here ZB, Japanese yen, ZN, British pound again, euro, and Canada. So again, you can play with this kind of on these assets as is from this day and figure out which ones you'd want to include and what kind of strategies you want to run. So that you can maximize again your profit potential what based upon this and again your allocation and what types of strategies to run. So in our case again, we got ZN, ZB. These are treasury rates, a trend following, apply that. And then here we have our euro, British pound, Japanese yen, Canadian. Those would be all mean reverting and nothing else. That's to stay defensive and maximize the opportunities currently in the markets based upon what these reports are generating. So you can kind of see the importance of this because you have a set of assets and you want to have the fewest amount to maximize the profit potential. All right, so people are going to go, "Well, where do I get this?" Okay, so I do have a file share here on my website, quantlabsnet.com. The unfortunate problem is under the file share here, I have the quant analytics. This is all payable now, okay? But if you are paying, this we just kind of started this process a few days ago. What you want to look for is the fix zip file under the Python, and then you'll get the source code in there. Now, again, I think this is so valuable. I may rerun this and actually use it in live trading at some point in the near future. Um, and I think that's really important. In here, also for other source code, you get the volatility dashboard. One other one I've not yet talked about in a separate video, regime changes. In here, I also have a CPP or C++. This one, there's a video on that on the gamma exposure with C++. This is pretty interesting as well. So again, you can see from an institutional point of view, you can really maximize your profit potential with these kind of scripts, and you get this. But the unfortunate problem is you've got to get into my quant programming elite membership, and again, that's right here under the and there's a bunch of courses in there as well. If you got questions, let me know. But again, what I'm showing you is behind a paywall. Oh, and also, let's take a look at the report, which is kind of helpful as well, wouldn't it be? Um, so let me just find that. Okay, should be right here. So this is a typical report I can generate from this case. There's 47 reports that I generated, and I generated into something like this. Okay. So again, that file I just showed you is how it's constructed. It's a massive Python file, but it does have all the data hard coded. But I could probably modify it. You can modify it to just take in generic um, parameters. So something like a SQL-like database for data management and parameters on the input. Um, and it's primarily a demonstration to showcase the capability of generating real-world dashboard simulations with optimally allocated futures and options trading combinations. That's pretty powerful what I've just shown you. Now, again, this is for demonstration purposes only, and this is based upon this one summary report that I've given that I've stated here. So here's all the assets available. So in here, I just want to highlight here that we've got currencies, as I mentioned, the different rates, the metals, which are not looking pretty good either, energy products like oil, gas, heating oil, agricultural products here as well. And as I said, I've just added late last week the crypto, but the only two ones I can do right now because I don't have enough history for Solana and soon to be XRP, but the only ones I can do right now is Ethereum and Bitcoin. So these are the symbols from Interactive Brokers. So in here we're using point in time. So these are snapshot from yesterday being actually May 5th. Okay, so from that point, uh, we're using ARIMA predictions, very short term over 10 days, which is normal. Okay, so the metrics we can use as part of the simulation is we're using historical volatility, which is annualized and over a 20-day period. We're also calculating an implied volatility as well, plus the option chain data I've kind of gone over. And there's also the correlation between the cash and the futures market for each asset. This will help measure hedging effectiveness and doing arbitrage analysis and some basic strategy payoff examples. Now in here, as usual, it might not be doing some of the other ones like CL or ES. There's no correlation between the different assets. So right now, because the markets are so messed up for both ES, which is the S&P 500, and oil, it can't calculate it. Uh, this is vital for true portfolio diversification. But because these assets are doing so poorly right now, they're not considered. So they're not true portfolio diversification. We also lack information from the user's specific goals. So this is based upon potential for speculating, hedging, income generation, and risk tolerance. That's pretty sophisticated. Okay. So here's how our allocation is measured. We've got a risk assessment, diversification, and again, I keep saying in the data we're providing it with the option chain data for each of the futures mentioned here, we're using simulated option chain data. It's very expensive to get that. Once I get that, I'll gladly put in the true stuff. But the only way I'll get there is to get more people to sign up for this. It's about $2,000 to $4,000 per month for this type of option chain data um, on the futures and options, not stock options, but or equity options. These are futures and options. So here, continuing along, we're measuring hedging potential. Again, to showcase potential strong negative cash future correlation, um, along with potentially some good hedging prospects, such as these. Plus, we can look at option because our reports have those built in for the bearish, neutral, bullish. So generally, we're looking for implied volatility based upon historical volatility. Um, and it's a direct comparison within the documents I provided it. And it gives us the implied volatility ranking, skewness on a call, implied volatility, and a put implied volatility. This suggests whether options are relatively rich or cheap, in the money, out of the money, hinting at buying or selling strategies. So, as I keep saying, and I've said this since day one, since I started this process, this is the so crucial data that helps you to get very accurate and quite possibly, again, demonstration right now, but quite possibly profitable strategies based upon what to trade, what not to trade, and what kind of strategy to apply. And again, it's all about in this current market that we've seen in a very low, well, it's a high volatile market, unpredictable with the current U.S. presidential doing his wild, crazy, unpredictable moves that greatly impact the markets. So we have to really look for uncorrelated, low volatile instruments. So again, low volatility. Here they are, mostly currencies, generally lower risks. So that's kind of where you want to be right now. You don't want to take on too many risky assets right now because they will have you lose money. Moderate risk, I don't think I'd even take right now. So again, we're involving the indices, the agricultural and softs. We're also looking at energy products and metals as well. Again, then we move into the highly volatile, which I wouldn't even touch right now. Again, some agricultural, soft products, some energy products, and more specifically, uh, Ethereum and Bitcoin, which are at higher risk. So again, we're looking for stronger hedging correlation potential. Again, these ones right here with good for direct cash and futures hedging. Okay. So here we have some weak hedging combinations again, which means hedging effectiveness based on this metric is uncertain or poor. So I wouldn't even touch those. And then we get into notable implied volatility, meaning there's some assets listed here which are higher than the call implied volatility, common and often reflects demand for downside protection or skewness in expected returns. So that's what we're trying to do here. If you have larger portfolios, trying to put on trades but still maintain a downside protection, especially in these markets because these are quite extreme. So in here, that's also involving selling puts, relatively more attractive, higher premium, buying puts relatively more expensive. And again, we're using that ARIMA for forecasting and finding those trends highly, highly variable and short term. So probably what I've shown, the 7 day may work best, or sorry, the 5 day for a week out. And here's one: ZP predicts a slight dip while ZX predicts a rise. That's one example. So you can see how sophisticated this is right now, as is. So what I've already, now I don't choose this. I don't feed these instruments. Okay. I give it the entire lot. It builds, this is the summary that it builds. And then I feed this report to create the dashboard that I created. So this is all calculated by an AI, not me. This is the beauty of it. All right, so here, portfolio allocation framework with a proposed $50,000 portfolio simulation. So what we're trying to do, illustrative example based around a balanced risk profile. This is what your folio portfolio analysts are supposed to do. Human based, but they're not going to do this. They don't have a capability. But with the automation, the full data set we're providing it with the different various strategy techniques, we're able to feed it into a general AI and come back with really good, I won't say accurate results, but better than what is out there. Okay. And then you get an actual allocation requirement based on the current data and consideration for personal risk tolerance. That's another key one as well. So if you're in your 20s, you can add in the medium risk if you want. In my case, if I'm in my 50s and I'm worried about closer to retiring, obviously my risk profile will be more conservative, meaning I have to take a much safer bet, meaning lower volatility or lowest volatility along with uncorrelated to other things as well. So here's our core holdings, lower volatility diversifiers. So that's going to be set at 40% at $20,000. Okay. So here we can put in these ones as well. though indices still have significant moves, so you don't touch them. So what we're going to add are some commodities and forex pairs. So it's a mix between ES, NQ, YM, ZN, ZB. Not, I don't know. I wouldn't touch them, but as I shown, I would tell you what I would do based upon in that dashboard I just shown you. So here we can use futures for a broad market exposure or rate direction. Option strategies like selling covered calls on futures or define risk spread verticals, iron condors could be considered, especially if the implied volatility seems reasonable. Given the lower volatility in rates of ZN, ZB, ZT, these might uh, form a stable base right there. Okay. So the rationale is to provide a base level of diversification and potentially lower overall portfolio volatility. Now you might be going, why would I hammer on or yammer on about this? From a career perspective, this is what a typical portfolio manager is going to be expected to do. If you want to stay profitable, if you want to have your track record over a year, 2 years, beating the markets with what we've seen with the deep down moves over the last month or so, and you're able to beat that and retain profit, and you're able to rationalize with what you're being presented here, you will be able to get into the multi-million dollar job positions, more namely in London, UK, because they're higher paying. So again, what I've said before, if you are less conservative in your 20s and 30s, you can be more aggressive. You can follow this advice. So you have metals, equity, agriculture, and some crypto related, and you can combine them, okay, where you have CL, natural gas, GC, silver, even some crypto, Ethereum and Bitcoin, allocate within the bucket depending heavily on the current market view and risk tolerance. So right there is your key, risk tolerance. So if you're in your 20s and 30s, you can be aggressive and take a chance. So with the rationale, what we're trying to do is capture the upside from commodity trends or volatility. With the option strategies here, we're going after with the high volatility assets, including Ethereum, might be suitable for premium, selling premium. So you'll be able to generate income from that when you take on a short for selling premium. Short calls, call strategies, iron condors, if you believe volatility will decrease or prices will stay range bound. You lower your implied volatility assets might favor buying options for directional. Okay, so we have different ways with the currencies. So again, suggested here, 30% would be these growth commodities as well, if you had 50,000. Here, with the currencies, you set at 15%. Here, what we're trying to do is have lower volatility than commodities. And again, we can apply these mixes of these currencies used to speculate on FX movements or hedging international exposure if applicable. Rationale adds another layer of diversification strategies and includes simple directional future or options. Spread strangles expecting movement. Here, if we're going to add in the hedging specific opportunities, we have 15%. So we're going to set, again, we're basing it upon a $50,000 account. Um, Here, this is really important to understand is we can have strong hedging characteristics if hedging on underlying exposure or specific based upon implied volatility analysis or perceived mispricing. So here we have the call put parity, which I've shown with a deviation through. Uh, these are hard to exploit. Okay, so when they say this is hard to exploit, if you know you're going to have some put call parity equilibrium distortions, what this is saying, what's highlighted here, the only way to do that is on a high frequency trading basis. And you definitely cannot do that with a retail broker. You'd have to sit on a futures broker with high volume on the CME to really take advantage of that. But if you were, as an example, to do that, we could do these assets. Hedging is a goal, or could be used opportuni- opportunistically based on current analysis, where an asset where the implied volatility will usually be low, highly compared to its historical peers. So the rationale tailor positions based upon specific goals. So you can see this is really, really detailed. I mean, I could go on. Okay, so we can refine the allocation using the documented data that we've got. Here we could use the volatility. We've got a correlation and be able to qualify and quantify exactly what we're doing using ARIMA if it's going to work or not. Some of them don't work in the reports if you were to take a look at them. So again, strategy selection. Okay, so here, all three different types of scenarios. Highly volatile, boom, 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 and we can apply selling the premium from an iron condor or a credit spread if expecting bound movement or volatility decline. So a range bound movement is, yeah, well, you should know what range bound movement is. If bullet bearish, consider buying debit spreads to limit cost. Again, that's institutional. Low volatility, that's what we want in the currencies and some of these treasury or rates, as it calls it, where the futures might be preferred for directional plays due to potential lower option premium. Buying option might be relatively cheaper if significant move is expected. So again, it's telling you should you buy or sell options. Coming back to the shorting on strong hedging opportunities on these two, with the ability to ask for long cash position and guide and calculate the optimal hedge ratio. And my course goes over that a lot. And you consider the variance reduction. And again, we have our disclaimers. It says here, get your professional advice. You won't get this type of advice through a professional unless they're a professional portfolio manager in a large operation. They wouldn't even be contracted with an NDA to talk about this at all. Again, this is all for demonstration purposes, but please be really aware of the capabilities here. So current data needed, I've mentioned that before, uh, and this is all hypothetical. Real allocation decisions must use current market data. We simulate the data. I've mentioned that since day one. But if there's enough of you, we can get the real data. So again, we've got to deal with calculating the volatility correlation price implied volatility daily. This tool can help you out, as what I've shown, with a 5-day or a 30-day simulation. This is another important one to find those uncorrelated assets. So we can use this sort of among all the other tools we've got to know the inner autocorrelation. So this is how these assets move relative to each other. Very important to understand that. And we're looking for true diversification requiring these correlations. If you do an uncorrelated way just from some platform, it's giving you pretty well next to very limited information. Whereas this is very accurate once we can work off of real world, true market data, especially in the options chain. So again, we have our risk tolerance. We can have our specific goals. And again, blah, 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 get professional advice. And it goes on and on and on. Okay. So it'll tell you, yes, there's critical missing data and very specific about it. So we'll try to use a simple allocation approach as is. And again, this is always rolling um, along each and every day. Okay. So again, really important. Now, I've spent half an hour on this, but if you are very interested in this, all I can tell you is go to our Learn tab and fill out your information. It's not released anywhere for anyone. The other thing I've just added here is in my groups. We've got a new public group right here, quantlabsnet.com public group. You can read all our detailed information specific to maybe some crypto assets, like in case we've got Bitcoin, we've got Tron, and the like. Other than that, thanks for watching.